Babies are a bundle of joy. But globally, there are between 48 million couples and 186 million individuals who live with infertility. IVF, or in vitro fertilization, may be one solution, but it can be invasive and expensive. This is something that 2+ Fertility is hoping to change.
Sperm count among men has halved in the last 40 years on average. The treatments that are available today are extremely sophisticated. IVF is a very advanced piece of clinical procedure. People do benefit from that, but not everyone needs that.
Singapore-based startup 2+ Fertility was conceived in 2019, just as one of its co-founders was going through his own challenges in starting a family.
My co-founder Ben, was facing this issue, and he started talking to me about it. And I found the space extremely compelling. We spoke to the leading experts. We realized that we've stumbled upon, a space that was ripe for innovation.
It took 2 years and 1,000 prototypes to create 2+ Fertility's Sperm Guide, a device that prevents leakage and directs semen where it needs to go. It's currently sold in Singapore and the United Kingdom. It's part of their line of products that couples can use at home to improve their chances of having a baby.
So, couples on average spend about $80 to $100 with us right now per month. The IVF market globally today is estimated to be about $30 to $50 billion, right? And we think that couples who don't need IVF is probably 10 times more than couples who need IVF.
It's this huge market potential that has won 2+ the confidence of its investors. All in, 2+ has raised around $7 million. Its recent pre-Series A funding round attracted $5 million from investors like Golden Gate Ventures.
They have great domain expertise based off of their education and their professional experience, so they really understand this space. The product is valid, protected by a good amount of IP, including protections overseas in other markets.
As an early-stage investor, Golden Gate Ventures has the challenge of finding out how much a startup is worth before putting money into it.
There's a lot of intangibles when it comes to pricing an early-stage company. Not only are we looking at that fair market value, which could be a combination of certain tangibles, the financials, the background of the founder, but we look at their potential to expand across the region. All of the unicorns that we're seeing in APAC right now, they are operating across a broad remit.
But it's not always easy to put a price tag on startups.
Whereas in the case of startups and VCs, it's a one-to-one deal, willing buyer, willing seller. Very often when VCs talk about fair market value, they benchmark you against sort of similar startups at a similar stage and looking at what kind of valuations and those kind of startups have. Unfortunately, this information is difficult to get typically for the average layperson.
Venture capital firms will typically gauge how long it will take for the startup to grow from inception to an eventual listing or sale to a larger company.
It's a high risk, high reward game. So in that sense, most VCs will look at your company and figure out, I'm not going to invest if there's no potential of like a 20, 30x. Now that number would vary depending on the risk appetite of different investors. However, in the case of VCs, I expect, let's say in my portfolio of 20 companies, to maybe have 2 big hits. So the 2 big hits need to support 18 write-offs in the worst case scenario.
Look out for the technology or the intellectual properties that the startup have. Because with this technology or intellectual property, it allows the business to be differentiated from the rest, right? And finally, what is the gestation period for the startup to reach the more mature stage? Like the longer the gestation period, then more funding will be required.
That aside, some investors are willing to bet their money even if a startup has yet to gain traction.
Valuation is not mathematical exercise. So we need to understand the industry, the business, and also the financial of the company. Prices are driven by the market sentiment and momentum, which can be sometimes disconnected from the intrinsic value of the assets. So investor will pay for potential value, even though the company are currently loss-making.
Venture capital funds across the region have their own criteria on assessing startups, but these usually boil down to the potential market size, the founders, and the product.
Their success as a founder is going to be predicated on their ability to fundraise and their ability to hire. And both of those things are really a function of how good they are at storytelling. And selling a story is as simple as like building an emotional connection with your audience, having the right narrative. Why are you doing this? Why should people join you? Why should investors give you their money?
Golden Gate Ventures has several unicorns under its portfolio, and it sees potential in 2+ Fertility becoming another billion-dollar firm.
It's such an appealing space. It's such a huge opportunity. Have absolute faith that they'll become a unicorn.
For 2+ Fertility, the next stage of growth includes launching an app and expanding into markets like the United States. They're hoping they can deliver on their goal of helping 1 million couples to conceive.